Thank you very much. I don't have an economy which I sort of represent and which I work, where I can actually share country experiences with you. So what I thought, I actually take a step back and talk about, maybe more in general terms, try to put things into perspective, talk about monetary policy frameworks. And if there's anything which we have learned from the crisis, is that we can't really separate monetary stability or price stability and financial stability. One reason is that central bank actions meant to safeguard monetary stability or price stability can actually affect the risk-taking of the private sector, and through that can affect financial stability. Financial stability in turn has, and I think we all agree on that, massive repercussions on output. And that obviously makes price stability fairly meaningless. I mean, if your GDP is in free fall, that's probably the first problem that you have. So I think we need to adapt central bank frameworks in order to recognize this independence. And I think Pilar's almost last words in saying that you have to take these things into account. I think that's sort of the way I would like to start. And let me start with the analysis that you have to do. So the problem is that financial stability analysis is much, much less developed than business cycle analysis. And there's a variety of reasons. And a trivial one is that the financial stability guys started later. Business cycle research basically started in the 1940s. There's a very well-developed set of tools, more or less coherent as far as economics, as coherent as possible in economics, tools to analyze business cycles. With financial stability, we don't have really coherent models. We have done much less thinking about it than about business cycles. Now, if it were only the late start, I think there would be hope. We would catch up eventually, but I think we won't, because there's also some structural problems. And the first one is actually a good one. There's actually not that many crises. So if you want to do research on business cycles and look at the US, you have got, 8 business cycles, 6 business cycles since the data started, but you only have one financial crisis. Now that's a good thing for the world, but if you actually want to study things, it's nice to have more bad times. The last problem is that crises are very different from each other. I once tried to cluster analysis, try to analyze the similarity of crises, and my result was that they're actually not similar at all. They're actually quite different, they're all unique, and to think, we've actually been through, or country X has been through that crisis which is similar to current crisis, so let's just do what they did, doesn't work. They're actually quite distinct. And that's probably one of the reasons why many crisis prediction models just don't work. They're very good at predicting crisis in sample, so past crises they're very easy to predict. Future crises are a bit more tricky, and they either predict 10 of the 5 crises that happen, or they don't predict any. But there's hope. There is actually some regularities in the data, and similar to what a monetarist would say, that inflation tends to be preceded by a sharp expansion of money. Actually, financial crises tend to be preceded by sharp rises in credit, credit outpassing and growing more rapid than trend, and for a shorter horizon, debt service ratios are actually a pretty good indicator. And there's a handout floating out around somewhere. It looks like that, and it should be somewhere. And there's a nice graph from some colleagues in it, which actually shows the predictive power of some of these indicators. Okay, that's the analysis part, which is very difficult, but I think somehow we're going to do that now. What can you actually do in order to safeguard financial stability? Before the crisis, and the only tool at the central bank where I worked at, which was the German central bank, was we wrote a financial stability review. That's not a terribly effective tool, so we could pronounce warnings, and people would politely listen, and then in the end shrug their shoulders and say, who cares? I think the other tool, obviously, which we had at our disposal for a long time, were interest rates. But interest rates, in order to manage crisis, interest rates, you obviously use them. To prevent crisis, interest rates have just massive side effects. And they may be ineffective for some financial instability. They may be more effective for like slowing sharp growth in credit, but at the expense of actually sending the economy tanking, and that's possibly not what you want to do. So the solution is macroprudential instruments, and that's not new. The word is actually old as well, but it's more fashionable now. But the instruments have been around for a long time. They may be new for some central banks, particularly for the advanced economy central banks, but many emerging market central banks have actually had a long experience with them. And some colleagues actually they try to find scored central bank reports of 60 countries in order to find evidence for macroprudential measures aimed at influencing housing markets, and they found more than 800 of such measures being taken. And there's also a table in this handout. So they're not new; they exist, but they're not going to be a panacea. So the available evidence shows that actually they're pretty good at increasing the resiliency of the financial system. For instance, raising capital ratios or reserve ratios actually makes your banks more stable, or loan-to-value ratios as well. There's much less evidence that they actually dampen financial cycles, that it would sort of prevent a large buildup in credit. And there's also a problem that, as of in the crisis management part, for instance, for some instruments like capital ratios, you would like to lower them in times of stress as well, but you can't. Or you can, but there's also a market-implied capital requirement, which is much more binding than the regulatory capital requirement during crisis. So they're a bit asymmetric as well. And the other thing is they're not fully independent of each other. So I think sort of in academic models, you can sort of have 5 objectives, and you have 5 instruments, and then you target them, and then you make a combination, even if they're correlated. It sort of works out because you know how to calibrate these things. But in practice, I mean, in these models, you would need maybe a capital ratio of 60% and an interest rate of -4%. In practice, this just doesn't work. So I think they're not as independent, and they may not work as well as we do. So I think interest rates are not fully off the hook. I think there's still a reason to use interest rates to prevent financial instability, not on their own, but in conjunction with other parts. Interest rates also have the advantage that they're much harder to evade. Macroprudential instruments, they almost all work through the banking system. And now in many emerging markets, we have an issue. We've got a lot of firms, non-financial firms, borrowing. And the problem is actually much worse than you think if you look at balance of payment data. If you actually look at offshore borrowing, the numbers are huge, and there's really not a macroprudential tool, which is particularly effective in order to prevent that from happening. Okay. Now we've got analysis, there's these instruments which central banks can now use. How do we actually put it to work? The problem is that financial stability or financial instability based on a financial cycle, on a credit cycle, and that has a very different frequency than the business cycle. And things don't move very rapidly. So I don't know who of you has written financial stability reports, but one of the problems you face is that you're always saying the same thing. And the crisis hasn't really materialized that you've been predicting for 2 years. It's materialized next year, but you sort of become little credible. And the same thing is actually, the same problem happens not only with the public pronouncement, but also happens within the policy decisions and the debate. Obviously, the financial stability guy has been warning for 2 years, nothing has happened, so let's just shrug it off. So it's very difficult to combine these two things. Now, I think the way to go, this my own opinion, I don't know whether there's anybody else in the world who shares that opinion, is we can borrow from the ECB's 2-pillar analysis to do that. So we have a macroeconomic pillar, which sort of looks at inflation forecasts and the more business cycle stuff. And then we actually cross-check with financial stability indicators. And for example, these indicators which I mentioned before, that can actually be quite useful. If credit has been growing rapidly, then it should be warning bell should be ringing, and then you should actually maybe err on the side of being too tight. Or if credit undershoots, you should loosen too much. And such a system, I think, to some extent exists at the Bank of Japan, which has two perspectives. But I think it's actually a fairly flexible system and could actually help us combine these different frequencies and these different types of analysis. What is important, though, you cover the entire system, financial system, and if something grows rapidly, no matter how benign it is and how benign people say it is, it's sort of something which needs to be looked at. Okay, now let me skip some governance issues which are extremely interesting. We don't have much time, but let's turn to exchange rate. Now, that's very much an advanced economy. What I said before was very much an advanced economy perspective. And for many emerging markets, but also for the advanced economy I live in Switzerland, exchange rates actually matter a lot. And even during the last crisis, countries which were sort of the most vehement adherents of floating, like Chile, intervened. And Chile, for instance, intervened on the upsides of before Lehman in order to prevent the peso from appreciating, and then they intervened after Lehman in order to prevent the peso from tanking. So even if you actually want floating exchange rates, there may be a point in time when you think, look, the fundamentals are so out of line with the actual exchange rate, or the other way around, that you may want to do something about it. Okay, how can we incorporate that into these frameworks? I think if you have more a peg, conceptually it's very easy because everything is subordinated to the peg, so you may have lots of problems in practice, but at least in theory you don't have many problems. With these sort of occasional sort of just reacting to strong imbalances, well, to some extent it's just like factoring in financial stability analysis. It's something which happens occasionally, it's something which builds up over time, and at some point you have to react. So I think it could be part of the second pillar, or two colleagues actually suggest a three-pillar approach. So have an exchange rate pillar, where you would have, for instance, in a monetary policy committee meeting, another perspective being considered and put on the agenda, and the policymakers would have to discuss it, or would commit to discuss it, which says, okay, look, how does this affect the exchange rate? Is it just way out of line? Should we do something about it? And then how should we actually affect move the other policies in order to try to get in line with prevent these massive realignments? So to close, I think such a system is much more messy than the traditional inflation targeting framework that we had. But I think it's something which could possibly, I think it would actually work. It would actually help us to keep the strengths of the inflation targeting of the pre-crisis frameworks, the focus on inflation, the reaction to perceived threats to price stability. But it would force us to take into account the trade-offs that arise, so of the side effects of the policies which are geared towards keeping inflation on. So I think it would be a lot of work, but it could actually make us end up in a better world. And I close with that hopeful note.